Okay, hello guys, I welcome you to my channel Notabene Tech on Tube with the continuation of skills. I have actually want to share this technical fact sheet, rights of access to accounting records when those records are held by a third party. And the contents of this fact sheet is general principles, rights of access to accounting records when cloud accounting system used, and Appendix A, record keeping rules if registered for VAT. Appendix B, record keeping rules for limited companies. Appendix C is record keeping rules for other general taxpayers. And example Appendix D is example retention of papers clause within terms and conditions. So general principles: documents belonging to clients must be given to clients or their agents if authorized to do so promptly on request or on ceasing to act for the client, exempt in those cases where members are able to exercise a right of lien. Okay, for documents belonging to members, the decision whether to allow clients or their agents to expect them rests with the members. Clients have no right to demand access. Okay, where clients ask members to disclose documents to a third party and those documents belong to clients, members must disclose the documents unless they are exercising a right of lien. Where documents belong to members, they are not obliged to comply with the request. Okay. Contracts between members and their clients. Any specific agreement reached between members and their clients about the ownership of documents will override any other concentrations. Okay, that's absolutely right. When you have an agreement, there is no other concentration to be taken care of. ACCA engagement letters include a schedule of services for the provision of bookkeeping services. This says that the member will prepare from the information and explanation provided by the client's books of prime entry. Okay, this says that the member will prepare from the information and explanation provided by the client's books of prime entry, then list those items. Under these terms, those books of prime entry would belong to the client. ACCA engagement letters include a schedule of services for the provision of bookkeeping services. This says that the member will prepare from the information and explanations provided by the client's books of prime entry, then list those items. Under these terms, those books of prime entry would belong to the client. Where the member's work is to prepare financial statements from the client records, the final financial statement belong to the client. Where the member's work is to prepare from the client's record, the final obviously belong to the client. If the client has specifically asked for other documents to prepare from them, then those would also belong to the client, such as draft accounts. Otherwise, they are likely to belong to the accountant. Further information related to legal ownership of and rights of access to books, files, working papers, and other documents can be found in this link. Okay, which can be actually read further, or might be. Let me check it if it's possible. Okay. Rights of access to accounting records when cloud accounting system used. The use of cloud accounting bookkeeping software has become more common in recent years. This involves a third party providing computer accounting software and computer file storage facilities to enable accountants and their clients to update and store the client's accounting records on a third party system. Questions there can then arise as to who owns the information stored and who has the right to access and retrieve that information. Under normal circumstances, there will be a contract involving a third party accountancy firm and or client. On a day-to-day basis, the software system will normally be available to both the accountant and client to update and retrieve information from. Problems may, however, occur if there is a breakdown of the relationship between these parties. There are a variety of situations that may arise, including the following. The accountancy firm ceases to act for the client. The accountancy firm ceases to act for the client, then ceases the contract with the cloud accounting system provider. The accountancy firm changes from one cloud accounting provider to another while still acting for the client. The accountancy firm changes from one cloud accounting provider to another after ceasing to act for a client. So there are a number of situations. Numerous issues may arise where access to the accounting records is restricted. Below are some examples. If the accountancy firm ceases to act for the client, If the accountancy firm has a contract with a third party, then the client is likely to lose. If the accountancy firm has a contract with a third party, then the client is likely to lose access to the cloud system when the accountancy firm ceases to act for the client. Absolutely understandable. As explained above, the accountancy firm should promptly give the accounting records to the client on ceasing to act for that client. The firm may wish to inform the client that they will need to make arrangements so that they can access their records and the time that they should have arranged this. If the client has the contract with the third party, then the accountancy firm should remove their access rights. The accountancy firm should ensure that adequate evidence is maintained on their own file so that they can defend a possible claim against them. It would be advisable to include a sentence within this disengagement letter stating that the firm will not access to the records. Okay, in normal circumstances, they will not require access to that clouding accounting system in the future. In normal circumstances, they will not require access to that cloud accounting system in the future. The sentence in the disengagement letter may state, accounting records. We state in our terms and conditions under retention of papers that you have a legal responsibility to retain records, to retain documents and records relevant to your tax affairs. Accounting records. We state in our terms and conditions under retention of papers that you have a legal responsibility to retain documents and records relevant to your tax affairs. On our disengagement, we will no longer have access to your accounting records you maintain on insert third party supplier, and you should liaise directly with insert third party supplier to ensure you meet your legal responsibilities. Yes, that is absolutely right. When third party is involved, especially when it is, you must mention the disengagement. Obviously, the first case is if the accountancy firm ceases to act for the client. So the cases A and B, and further down the road you have also further down in the sub part of B, there's the accounting records and the treatment that must be mentioned by explaining it with a one-liner. And number 2 conditions among the 4, if the accountancy firm has a contract with a third-party cloud accounting provider and the contract is terminated. Okay, if the accountancy firm continues to act for the client, then the client will need to ensure that advocate records can be transferred from that third party. Access to the accounting records is likely to be limited after the contract is terminated. The letter of engagement between the accountancy firm and the client should specify whose responsibility is to transfer these records. For example, if the accountancy firm stops paying the third party, then the contract may be terminated by the third party. The third party may also be able to limit access to the client accounts from the time the payment ceases until the contract is terminated. Under these circumstances, the letter of engagement between the accountancy firm and the client should specify whose responsibility is to have stored the client's records. If the accountancy firm has that responsibility, then the client may be able to sue that firm for the damages and costs incurred in recreating those records. If the accountancy firm no longer acts for the client, then if the records have already been transferred to the ex-client, no further action should be required. If the records have not been transferred, then there are 2 possible consequences. One is that the ACCA rules relating to transfer of information on ceasing to act for a client has not been complied with, and it may not be possible to comply with in the future. And these records will be held by the third party who may be preventing the accountancy firm from obtaining access. The other consequence is that if the accountancy firm is responsible for keeping the accounting records for the client, then that client may be able to sue the accountancy firm for the damages and costs incurred in creating those records. The terms in the letter of engagement and notification within any disengagement letter may be important in this situation. Okay, if the client has the contract with a third-party cloud accounting provider and the contract is terminated, as the client has the legal obligation to keep adequate accounting records, the accountancy firm should have no legal obligations when this occurs. Okay, their main issue may be that they have carried out work to update the information stored on the cloud accounting system, and they will want to be paid for that work even though the client may no longer have access to it. Okay, how long should accounting records be retained for? How long accounting records should be retained for will depend upon a number of different factors. They are explained in more detail below, but it is often the case that they should be retained for 6 years or more. Okay, if the accountancy firm is responsible in some way for retaining those records, then if the accountancy firm requests a third party to if the accountancy firm is responsible in some way for retaining those records, then if the accountancy firm requests a third party to retain the records on its behalf, it needs to ensure that the agreement between the accountancy firm and the third party storage provider meets the requirement of the accountancy practice. Okay. If the third party is retaining the accounting records of the client, then the accountancy practice should ensure that the terms of engagement with that client are appropriate. Appendix A, record keeping rules if registered for VAT. The basic rule is that you must create and retain normal business records. Most bookkeeping and computer system will meet their requirement. VAT law requires you to keep your business records. In the view of HMRC, those records will include annual accounts including profit and loss accounts, bank statements and paying in slips, cash books and other account books, credit or debit notes you issue or receive, documentation relating to dispatches, acquisition of goods to from EC member states, documents or certificates supporting special VAT treatment such as relief on suppliers to visiting forces or zero rating by certificate. Documents or certificates supporting special VAT treatment such as relief on suppliers visiting forces or zero rating by certificate, import and export documents, orders and delivery notes, purchase and sales books, purchase invoices and copy sales invoices, and records of daily taking such as till rolls, relevant business correspondence. If some of the above records are not normal records of your business, then you will not need to produce or keep them, but equally some businesses will create additional business records and they must be retained and produced to HMRC on request. In addition, there are two records that are specifically required for VAT in the VAT account, which needs to show the link between the output text in your records and the output text on the VAT return, and similarly for inputs. The specific information required is outputs, the output tax you owe on sales, the output tax you own on acquisitions from other EU member states, the tax you are required to pay on behalf of your suppliers under a reverse charge procedure, tax that needs to be paid following a correction or error adjustment, any other adjustment required by VAT rules. Inputs, the input tax you are entitled to claim from business purchases, the input tax allowable on acquisition from other EU member states, and the tax that you are entitled to follow or correction or error adjustment, any other necessary adjustment, a VAT invoice for suppliers to other VAT registered businesses. A VAT invoice is an invoice that contains the following information: a sequential number based on one or more series which uniquely identifies the document, the time of the supply, the date of issue of the document where different to the time of supply. The name, address, and VAT registration number of the supplier, the name and address of the person to whom the goods or services are supplied, a description sufficient to identify the goods or services supplied. For each description, the quantity of the goods or the extent of the services and the rate of VAT and the amount payable, excluding VAT, expressed in any currency. The gross total amount payable, excluding VAT, expressed in any currency, the rate of any cash discount offered, the total amount of VAT chargeable expressed in sterling, the unit price, the reason for any zero rate or exemption. Special rules apply to invoices issued under a margin scheme or subject to a reverse charge. If you provide an invoice to a person in another EU member state, you must also show the letters GB written in front of your registration number for cross-border supplies, the registration number of the recipient of the supplier preceded by the alphabetical code of the relevant EU member state, a reference to any means of transport. How long should VAT records be retained? Generally, business records for VAT must be kept for at least 6 years. If this case causes problems due to the lack of storage or undue expense, then HMRC may allow some of the records to be kept for a shorter period. Records can be kept on a computer or a number of computers. If a business is sold or transferred as a going concern, in most cases the seller of the business will retain the business records. However, the seller must available to the buyer make available to the buyer any information the buyer needs to comply with his VAT obligations. Understandable. Where the buyer takes on the seller's VAT registration number, the seller must transfer the records to the buyer unless the seller needs to retain the records. If necessary, HMRC may disclose to the buyer information they hold on the transferred business. HMRC will do this to allow the buyer to meet his legal obligation, but HMRC will consult the seller first to make sure they do not disclose confidential information. This is a financial penalty for failure to keep or produce the records required by law. VAT Notice 721 contains guidance about keeping VAT records, and this can be found in this. So the above appendix is actually more applicable in the VAT scenario, basically in the UK and the EU, but you can extract the relevant applicable, you can say, legal information to your setup or to the land of law. But record keeping if registered for VAT is for the record keeping rules if registered for VAT. And for the next one, we can have the appendix B, which has to be there, but it is appendix C is going okay. Appendix B, record keeping rules for limited companies. The companies are required to comply with the Companies Act, and Section 386 of the Companies Act 2006 lays out the duty to keep account records as follows. Every company must keep adequate accounting records. Adequate accounting records mean records that are sufficient to show and explain the company's transactions, to disclose with reasonable accuracy at any time the financial position of the company at that time, and to enable the directors to ensure that any amounts required to be prepaid comply with the requirements of this Act. Accounting records must in particularly contain entries from day to day of all sums of money received and expended by the company and the matters in respect of which the recipient and expenditure takes place, a record of the assets and liabilities of the company. If the company's business involves dealing... Okay, now for the appendix B, record keeping rules for limited companies. I have gone through this, and Section 388 deals with where and for how long records to be kept and states the following. A company accounting records must be kept at a registered office or such other place as the directors think fit, and must at all times be open to inspection by the company's officers. If account records are kept at a place outside the United Kingdom, accounts and returns with respect to the business dealt with in the accounting records so kept must be sent to and kept at a place in the United Kingdom, and must at all times be open to such inspection. The accounts and returns to be sent to the United Kingdom must be as such as to disclose with reasonable accuracy the financial position of the business in question at intervals of not more than 6 months, and enable the directors to ensure that the accounts record to be prepared under this part comply with the requirements of this Act. And where applicable of Article 4 of the IAS regulation, accounting records that the company is required by Section 386 to keep must be preserved by it. In the case of a private company, for 3 years from the due date on which they are made. In case of a public company, for 6 years from the date on which they are made. Subsection 4 is subject to any provision contained in rules made under Section 4.1 of the Insolvency Act 1986. This and this. Appendix C, record keeping rules for other general taxpayers. Excuse me. Records should be kept to support all the figures that should be entered on the self-assessment tax return, as HMRC. Okay, record keeping rules for the general taxpayers. There are a number of factors that affect how long records to be kept as follows. Self-employed people must normally keep their records for at least 5 years from the 31st January submission deadline for the relevant tax year. That's perfectly okay. For example, if the tax return for the year ended 5 April 2016 is submitted on and before 31st January 2017, then the records for the year ended 12th should be kept until 31st January 2022. Okay, that is for the next coming 5 financial years. Okay, if the tax return is sent into HMRC before the deadline, then records should be kept for at least 22 months from the end of the tax year relating to that tax return. For example, if the tax return for the year ended 5 April 2016 is submitted to HMRC on and before 31 January 2017, then the records for the year ended 5 April 2016 should be kept until at least 5 February 2018, the next 22 months. Okay. And if the tax return is sent into HMRC of the deadline, the records should be kept for at least 15 months from the date the tax return was sent to HMRC. Records relating to capital gains tax must be kept for at least a year after the self-assessment deadline. The records should include details and evidence related to the purchase of assets that were disposed of. These purchases may have occurred many years before the tax return year. If HMRC has started to investigate a taxpayer's tax return, then records should be kept for long periods. There is guidance on the government.uk website on the subject, which can be found at this. Appendix D, example retention of papers clause within terms and conditions. Retention of papers. You have a legal responsibility to retain documents or records relevant to your tax affairs. You will not retain these accounting records for you, and you should assure that you have and maintain access to these records. Where the accounting records are accessed by a third party, you should ensure that you maintain access to your records. You maintain access to your records. During the course of our work, we may collect information from you and others relevant to your affairs. We will return any original documents to you if requested. Documents and records relevant to your affairs are required by law to be retained as follows: individuals, trustees, and partnerships with trading or rental income 5 years and 10 months after the end of the tax year, otherwise 22 months after the end of the tax year. Companies, LLPs, and other corporate entities 6 years from the end of the accounting period. While certain documents may legally belong to you, we may destroy a correspondence and other papers that we store electronically or otherwise that are more than 7 years old. You must tell us if you require the return or retention of any specific documents for a longer period. So this is the whole technical fact sheet, and it's more than how actually rights of access to the accounting records, especially in the cloud environment. And there are various scenarios, various you can say situations, and the applicable rules that may apply for that relevant situation or scenario is being discussed in this fact sheet. You can go through again and again if you are working in the VAT or in a UK framework, accounting framework, and then you may go through this fact sheet. Otherwise, with some alteration and with the relevant applicable law, you can actually cross-check how it has been applied in other land or other laws around the world. But it's more or less the same, I believe, apart from the difference of the name given to the VAT, and apart from some other differences specifically to the tax, specifically tax-related, actually you can say principles or the requirements in a given law. Apart from that, more or less, this fact sheet is applicable elsewhere in any accounting and finance environment. So I suggest you to just go through if you are interested in getting the rights of access to accounting records, especially in the case of a business when you are running in an environment where it's actually, especially because the purpose of the fact sheet is normally in a software house. When we are dealing in a software house, we normally come across with the softwares which are normally being owned by third parties, and we are dealing normally on the basis of apps as well. If you own the app, that's perfectly okay, but if the app or the software is owned by a third party, so the rule of a third party and the rights of access to accounting records normally prepared by a third party app or a software is, you should know how you're going to how you going to apply yourself if you are using so much of the third-party softwares or apps. For that reason, I have just gone through this technical fact sheet. So if anyone is interested in asking any of the further questions, we can go and dig deep what are the other scenarios or what are the other situations if you want to have if you want to actually apply it for a software house or for any accounting firm, or even if you want to have any transactions in general. So I'm going to end up my video altogether on this with this technical fact sheet. I may come across now and then with the technical articles and the technical fact sheets related to the different environments, to different industries from the different financial years, and I hope to keep you and also myself at the end of the day updated. And let's see if we are able to actually extract the subscriptions, and also we'll able to turn that subscription to our future long-term customers or the prospects as well. So I'll keep on working, I'll keep on trying and pursuing with the path of consistency, and with the constant approach, I hope that we'll able to meet our targets well before time. So I appreciate that you have watched our video, and keep watching our other videos as well, so that you can see that what are what we are doing right now, and what we are going to do for your client, for you as a client, or for the customers. So I thank you again. Take care and have a nice day.